right, I guess we'll get started here. Welcome to our interactive webinar on unlocking the true value of your business. My name is Amanda. I work for Stratus Business Advisors with Sam Brownell, who will be discussing with Josh and Randy throughout this presentation. As you have questions, please feel free to put them in the chat at the bottom, and I will ask them throughout the presentation. We also have received some questions ahead of time that we will probably feed in. And thanks for your time today. And with that, I will turn things over to Josh.
Thanks, Amanda. Hey, everybody. So for those of you who don't know me, Josh Wynn with Wynn Wealth Management. Randy and I work together for the last couple months, and it's become a great team approach. And we've actually started working with Sam and Amanda over at Stratus Business Advisors. A lot more than we expect to do very quickly, all in good ways. And we've been working on the key transitions. I know a lot of us have seen it in the media, clients, other business advisors of who do you turn to? What do you do? What's succession planning look like? Because one, we know all these baby boomer business owners are transitioning out as they age out, but you're also seeing a lot of people in their 30s and 40s recapitalize businesses, buy new businesses, start new businesses. And Sam and Amanda and their team have been instrumental in helping us and our clients with some of these, one, key transitions, but two, the questions that we have. So I wanted to bring everybody together to, one, have them as a resource, but two, go through the process, valuations, transitions, options, everything from start to finish, so that you all, again, in your own clients or in your own situations, can understand what to do, who to turn to, but also have Sam and Amanda as a resource. So like Amanda said, if you have questions, please go through the chat. We've probably got 6 or 7 already kind of queued up from people in the past, and I know we are going to record this for some of the people that couldn't make it today. So with that being said, I'm going to turn it over to Sam and let him rock and roll.
Awesome. Thanks, Josh. And thank you to you and Randy too. Great partners. We're really excited to be here with you and to just keep growing this relationship, because as Josh said, we're at a point where over the next decade to 15 years, there's going to be a lot of these transitions, and it could be from retiring owners, or it could be just a transition, right? A business is looking for a new owner, or somebody has had enough and they're out. And what do we do, and how do we create wealth? And really, it's about, part of it is about putting together the right team and having people with the right expertise, because we do cover a lot of different areas when we talk about a succession plan. And some of them are very specific, right? There's specific tax advice, legal advice, obviously in planning, right? Long-term planning for your personal, because as we all know, businesses and the personal side, it's very hard to divorce those two. Those are two very intertwined pieces of any business owner's life. So let's jump in here to get through this presentation, and then we'll start taking questions as we dive deeper into the slides. But here's really what we're going to look at today, right? And this is a high level view of what succession planning does look like. And I think that one of the things that we find when we talk to business owners and our clients is this is a process, and you have to be willing to go through that process, and you have to be able to explain it, and you have to be patient, because there are lots of stops and starts, because the one overriding piece of any succession plan is emotions. It's very difficult to think about not running your business or bringing on a partner. Those are emotions that people feel deep, because typically you've run a business for 30 or 40 years, even 5 or 10 years, you feel a deep connection to that business. And so it's hard to think about, how are we going to bring somebody on? What is that going to look like? How do we make sure that we're protected throughout this process? So anyways, this is what we're going to chat about today. For the third time, make sure that you ask questions. Right? The whole idea here is that we get some good interactive dialogue going on. Just a disclaimer from us. Remember, this is not tax or legal advice. We're here to talk about the succession planning process, to answer some questions, to tell some stories, but nothing here should be construed as either tax or legal advice. So let's start here. This is really the bottom line, is what is the business worth? And two things that are important with this piece. Number one, most business owners think their business is worth more than what it actually is. And couple things to think about here, and things you may hear from clients is, well, my buddy next state over just sold his business for 5.5 times earnings. I'm at least as good a business owner as he is. I should at least get that much. Maybe, but maybe not. And the thing about valuation is that when we get into it, it's more than just the numbers. It's does somebody have operational processes and procedures in place? Are they using technology? In a lot of industries. So let's think for instance in some of the industries. So Amanda and I do a bunch of work with manufacturers. There are still people who are running their business out of Excel spreadsheets when there is enterprise software that will link together financials with receivables, with data, with customers, so that you can get a real-time look with inventory. What do we have? What do we need to order? What are our clients ordering? Who are our A clients? Who's doing the most business with us? All of this stuff, it becomes really, really important to what a business is worth, because part of what a business is worth is how marketable it is. Who wants it? And if I'm running a great business and I think it's a great business, it gives me a great lifestyle, but nobody out there is interested in it because I'm the only one who can run the business. And without me, 80% of the clients leave. That's not really that great of a business, and it's not really worth that much to anybody else, because if I'm not there, the business doesn't work. So really getting in there and doing a deep dive valuation, and when Amanda and I jump in here, and this is something that we talk about a lot with Josh and Randy too, is you need to know what is going on under the hood, and you need to get that objective evaluation, because if you're not doing that, what happens oftentimes, and we see this quite a lot, there are a lot of groups out there, associations, purchasing groups, who have put together their own marketplace for businesses. And we'll go down and look through those because of our work through associations and purchasing groups. But we'll see things on there, for example, so and so has a hardware store in rural Vermont. They're doing $1.5 million in revenue, and they're asking $3 million for the business. Business is never going to sell, right? That's like having a rundown shack in northern Vermont and asking $1.5 million for it. It's just not going to happen. And so that reality, I think, becomes a really important starting point, because without that, it's very difficult to do all the rest of the planning. So let me jump in here quickly and go over high level different ways that businesses are valued, and private businesses are a little bit different, right? We don't have a market where we can go out and see what things are buying and selling for. And so typically we look at two things. We look at the balance sheet, we look at the income statement. On the income statement, we're looking at what many folks have probably heard of as a discounted cash flow. Another way to do it is a capitalization of earnings. That's really the difference is how long you're projecting into the future. And then this last piece of comparable transactions. What are other businesses trading for out there? What are other businesses like yours selling for? And this becomes a very interesting process of trying to figure out which one of these approaches gets at the heart of what's going on with the business. Because to be honest, sometimes we'll only use one approach. Sometimes we'll have to weight multiple approaches depending on how good we think the data is. And so it is a process of trying to figure out what's the best way to triangulate into a value that we feel is not only fair, but also defensible. So I think I'm going to take a quick stop there and see, Amanda, do we have any questions, or Josh, anything to add here?
Yeah, I mean, again, Sam, the data speaks for itself, because I want to make sure we kind of drill down for a lot of the people. And again, we're that little moniker on ours is CEPA, so Certified Exit Planning Advisor. I was actually looking at the data before we hopped on. Is 80% of businesses don't sell. And Sam, you're probably in that mindset of probably 40% of those are because asking price is ridiculous. Again, asking $1 million
Yeah.
for a rundown shack. And then the other 40% is probably just no plan or no succession plan.
Yeah.
As you're seeing that go forward, because this was one of the questions I know that was kind of in there beforehand, is how long should, if a business owner is looking to exit, family succession, all those kind of things, when should they start this process in general?
Yeah, that's an excellent question. And ideally 3 to 5 years, 3 to 5 years out before they exit would be the right time to get that business valued and to start talking through some of the things we'll get to next in the planning process. Because really two things, Josh. I think number one is it takes more time than people think, because one, you're trying to run a business too, and trying to keep that business going. Two, because it involves people. And anytime you're dealing with a transition of people, whether it's family, whether it's key employees, or even if it's a third party, an outside buyer, it takes time, right? There are negotiations, there are emotions, there's back and forth. There's, well, how many options do I have? And how many should I pursue at this time? And we'll talk about some of the different options later. But 3 to 5 years is a good thought process and a good place to start. I will say though that one of the things that everybody should be encouraging their clients to do is start thinking and running your business like you're going to sell the business one day. This is an asset, right? It's just another asset in your portfolio. It's like a stock, a bond, an insurance policy, an annuity. Same thing. The business is an asset. And it's an asset, quite frankly, that unlike a lot of the other assets that folks own, you as the owner or your client as the owner have direct control over how that investment grows. Your decisions, positive and negative, lead directly to the ultimate value of that business. And so I think it is really important to take away some of this stuff and start thinking about how do we push margin a little bit? Do we have the ability to go and find comparable data for our industry? Right? If we're in an industry and the industry average is about 23% of revenue, let's say on payroll, and you're paying 25 or 26%, well, you have to figure out, are you overpaying people or are you actually getting a return? Maybe you're paying people and they're so good that you're selling more than your competitors. But that benchmarking process, I think, is really important for folks to do on an ongoing basis, not just when they're thinking about selling a business.
Yeah. All right. So same thing, kind of people who are getting LOIs unsolicited. Where do they start with those? Because I think, I mean, we've talked about in the past, the facility services, HVAC, plumbing, a lot of those kind of hotter industries, they're
Yep.
starting to get those, whether they've asked for them or not. Where does a client, what is their CPA, their attorney, where do they start with those types of things?
Yeah, yeah. Well, first of all, tell them congratulations. You
Yeah.
must be doing something right if somebody is pointing to your business and saying, "Yeah, I think that might be a business we want to acquire." And you're right, Josh. In a lot of these trades types and industries in particular, there is a lot of private equity backed money and folks looking to roll up good companies, especially companies that may be multi location or are selling to some niche, right, at higher margins. So, so a couple things to do first. Number one, with any LOI that you get, make sure that you take it to an attorney and read it and have them read it and just talk about what's in there, because in any LOI there's going to be things that are binding and then there'll be things that aren't. And so that's the first place to start. The second place is take a really good look at the price and try to determine or talk to somebody who has valuation experience whether or not that is actually a reasonable or fair price for your business, because there's a lot of fishing that's going on out there. Right? There's a lot of sales folks out there who are just reaching out and trying to
Hoping they
buy.
hit. Yep.
I mean, I'd say every week, so I get an email at least from one or two people trying to buy Stratus, and for the most part, they're fishing, right? They just want to see if I send it to 1,000 people and I get 20 responses. That's pretty good, but but that's definitely something to do, and we help, and we've helped in the past numerous people try to decide, is this something worth pursuing?
Yeah.
because sometimes it is, but if you don't know whether or not that value is a good one or somebody's just trying to pick it up on the cheap, then that can be a problem. And what happens, Josh, and one of the things that we see a lot too is that it can be flattering, right? Oh, wow, somebody wants to buy my business, or geez, I didn't even realize this thing was worth money. And now somebody's going
Yeah.
to give me $5 million for it. Well, we need to determine whether or not that 5 million is good, or maybe a business is worth 8.
Right. Or what strings are attached to it, or all those types of things.
So yeah, so I would definitely say those are the first two things. Review it, have an attorney or another trusted advisor take a look at it. Objectivity is huge, especially when you start talking about these types of documents and the money that they're throwing around. It can be very easy to get lost in the money side of things. Get somebody to objectively take a look at what your business is worth. And then certainly I think, and you mentioned CPAs have a huge role in this, which is to talk to folks about the tax piece of this, because let's face it, a third-party buyer, an asset sale is typically going to be more tax disadvantageous than a stock sale. And so you need to know that too, because really, if somebody's going to give me $5 million, but I'm going to pay 40% of it away in taxes as part of the sale, then I'm not really getting $5 million.
Right.
And that hurts, right? I'm really only getting $3 million. And that could be a big difference when it comes to planning and intergenerational wealth and all these other pieces, legacy.
Deal. Okay. I think that was the questions for those so far. So if you want to.
Awesome. That's great. Thanks, Josh. No, good stuff. Amanda, do we have anything else or?
The only other question we have that ties into that is, so you mentioned that, 3 to 5 years is the ideal time period to consider getting evaluation and preparing for sale. However, before then, you should be running your business like you're going to sell it. So what are some strategies that business owners can use now to increase the value of their company when they do get to that point?
Yeah, no, that's a great question. So I would say let's focus on three things. Number one, benchmarking. See, every one of your clients is part of an industry that has an association or maybe many associations. A lot of times these associations or even the purchasing groups that they belong to, the wholesalers, will aggregate data on industry participants. What are gross margins? What are operating margins? What are folks paying as a payroll, right, as a percentage of revenue? What does growth look like in the industry? What are taxes look like? These are really good ways for you just to get an idea of where you stand in the industry. Because remember, part of this is we're not going to be selling, a manufacturer is not going to have the same margins as a CPA business, let's say, or another service-based business. And so it's what's going on in your industry that really matters, and making yourself a rock star in your industry is the way to do it. Don't compare yourself to another industry, but you've got to benchmark it to do it. And there is data out there, but typically you're going to have to go through an association or a purchasing group to do it. So that's number one. Number two would be take a really good look around at your people. Make sure you have the right people in the right seats, and make sure that there's a process where if folks have been around, you've got those people in their 50s and their 60s who have been in the working world for 25, 30 plus years. Are they mentoring? How is that knowledge getting out of their head into processes and procedures to teach younger folks? I think that's an incredibly important part of this, because we talked about it earlier. If the business is relying on one person or two people, that's a really, really tough business to sell, because it's going to come with, and Josh mentioned, a lot of strings attached, right? That owner may want out, but the buyer's going to say, no, that owner can't leave, or else if he
Yeah. I need you
does,
for 5 years. Yeah,
yeah,
exactly. Yep.
or we're going
Well,
to build in 50% of the sale price in an earnout.
yeah. Well,
And
and Sam, I know you've probably seen as much as I do, like the key person side. Again, even if it's
Mhm.
not owner dependency, but it's 2 or 3 salespeople or something like that. If
Oh
they're
yeah,
close to retirement, not about to leave, they don't like the new owner, those types of, I mean, that can, and we've seen it crush business sales on
oh yeah,
the earnouts 1 year, 2 years down the road, that just people don't hit them anymore. And that's part of your
no,
money.
no. And I think that's a great point, Josh, too, is that if a lot of businesses, if the owner is 62, most of the key people are going to be within 5 years.
Yeah.
of his age or her age. And so that's going to create its own issues where a lot of times they don't want to work for, even if it's a family transition. Well, geez, I work for Josh. I don't want to work for Sam.
Yeah.
So yeah, I think that's a really good point. The other thing I think we're seeing with a lot of businesses nowadays, and let's sort of focus specifically in the trades, but even outside of it, is not being quick enough to invest in technology and to use the tools that are available to help their business run more efficiently, number one, but also to attract that next generation of talent. It's very difficult to attract younger folks if you're still writing orders by
By hand.
hand.
Yeah.
It's going to be difficult to attract and retain that next generation of talent, and you're probably going to be leaving some money on the table in terms of your margins. So just make sure you're thinking through some of this stuff, both from a benchmarking, but then from an operational. What's your leadership management look like? And then this piece about making sure technology and this outreach to the next generation, I think is really important, because there's always this push and pull about, those young people, they don't do it like we did. But that happens every generation, right? It's about finding ways to connect with those younger folks and put them in positions where they can succeed and understand what they want to see in the working world. Because in some cases, like with technology, it could actually help the business as a whole, right? That seems to be a no-brainer. I think the last thing I would say too is when we start thinking valuation, one of the things that we're backing out of your cash flow when we're valuing that business are going to be non-recurring charges. So if I'm spending $100,000 on a new technology platform, that's a one-time charge, right? I'm not buying that platform every year. Yes, there are going to be ongoing costs to maintaining it or to having the service or the training, but that initial onboarding cost or building that system specifically for my business, that's a one-time non-recurring charge. A lot of that gets backed out, right? That's an add back to cash flow, which then increases your value. So think about this when you're making an investment in the business. I think the other thing is, if you're not investing in this, whoever's buying the business will likely have to. And in their head, they're thinking, well, geez, if I'm going to have to put at least $100,000 down on this, plus all of the hassle of integrating the business and figuring out which employees stay and not, I'm taking $200,000, $300,000, $400,000 off my price here. So it becomes real money pretty quickly.
Yep. And it's again, same with the house. If you know the roof has to be replaced, you don't really want to pay for the roof as if it's new.
Yeah, exactly. And so think about this stuff too, because you're right. A business, in many ways, it's like selling real estate, and I think that's a very good analogy.
Awesome.
So yeah, so I think we've hit on a lot of this stuff on why valuation matters here. So I'm gonna kind of go through this, and we can come back to any questions that come up. But the real two things, I think these first two things are really important. One of it is objectivity, right? There's so much emotion that goes into it. And again, Josh, I think your house analogy is the right one. If you've lived in a house for 40 or 50 years, there's an attachment to it that goes beyond just what the market will bear for that house. And you might be disappointed. I remember when my mom's dad died, and my mom and her sister were unhappy with what the offers we were getting. Whereas I was thinking, or the real estate agent was thinking, boy, this is really good. Like, we're getting a good offer for this house. So that's where that objectivity comes in, somebody that can cut through some of the emotions of this. And the other thing is this due diligence piece. And this becomes really important regardless of who's buying the business, but particularly if you're going to go and look at an external, a private equity backed roll up, a strategic competitor. This is a process that it is good to have somebody dive in and do before you open your books up to a potential buyer, because you want to get those hard questions asked. Well, geez, why are you running this? I see there's a loan for a boat here. What is that doing on the books? Or, geez, you've been paying Aunt Susan to $75,000. What is she doing for the business? She comes in twice a week and maybe reconcile some bank accounts. All right, well, we need to think about that. And it's not necessarily that you need to kick Aunt Susan to the curb, but you need to have some good answers for questions so that you don't get blindsided in due diligence. And just think of it as in your clients or in the buyer of your client's business head, they're just ticking off. Every question that comes up raises more questions, and the more questions they have, they start going, well, that 5 is looking more like 4 times 8 earnings. Now it's looking like 4 times 7, 5. And this is, again, this is real money that is being left on the table by not getting ahead of the game and understanding where you stand.
It's the pre-due diligence.
Yeah, exactly. Exactly. And so it does become really important. And I think we've kind of hit on this other stuff, and it is this last one, kind of to your point there, Josh, before, is if you get that LOI, you really do want to determine whether or not this is something that's viable, or if this is something that you can just, it's kind of throw in the trash can and say, well, now at least I know that my business is worth 8, not 5. And so anything that's coming in
Yep.
really below high 7s, I'm not even going to talk to that person.
Well, and it's the same thing from our side too. Again, if we're doing wealth planning and income planning for that retirement or generational wealth planning, and you think your business is worth 10 and it's worth 7, okay, well, that's a very different number, because then after taxes, it's worth this. And then it's the same thing from the estate side. Again, if you don't really know what your business is worth, then how can you effectively estate plan at all? And most people say, oh, it's worth about blank. Well, about doesn't normally work that well. So
No, I think, and it's a good point, and it's interesting. We were just having a conversation about a week or so ago with a client of ours who was so happy. Oh, geez, thank goodness that they didn't, the sunset on the estate tax exemption didn't make any difference, right? Well, this person owns real estate and a business that's worth in the mid-20s, and even with a 30 million cap that's going to increase with inflation, if your business is likely to grow faster, and particularly your real estate to grow faster than inflation, we calculated that at 10% growth within 3.5 years, this person would be subject again to the estate tax. And so
yep.
Knowing really helps you plan, and I think that's the point.
Yeah, even if you're not selling, even if it's just a family succession, I mean, that can be just as bad.
Yeah, exactly, because you just never know, and it is sad and tragic that these things do happen. But we, just within the last 8 months, we've had 2 clients who have had unexpected deaths of owners
Yep.
in the business. And this stuff,
Yep.
sadly it happens, right? And if you don't know, boy, it can be, one of these in particular has been a real struggle, because the owners that are left are trying to lowball the offer to the estate of the family. And we came in to value the business, and we said, no, it's not. I mean, you're giving about half of what the business is worth. And so it can get ugly, and you want to avoid that, because it's time, money, and emotional energy.
Yeah. And that's what you'll find if your business is very owner dependent, then on those types of things, the fire sales come out, and it's not good for anybody.
Yeah. Yeah. And those ones definitely, those ones hurt.
Yeah.
The fire
Yeah.
sale ones. Yeah.
Yeah.
Yeah. And this is a good segue here into a couple discussions, but this idea, right, of kind of business fund your retirement. And this is where we're always big fans of owners who are clients and have worked with financial advisors, have good tax advisors, because let's face it, a lot of owners, this is where they reinvest their money, right? Is into the business. So
Yeah.
they're not necessarily building up
It's
wealth
90%
from
of
the
their
business.
net worth most of the time, 80, 90%.
Yeah. Right. And so then they're relying on this sale. And that can be hard, right? And I think you just hit on this first point, right? It's typically the largest asset.
Yeah.
And then when you start taking taxes into account, that 7-8 million could be 5 if it's not planned well. And back to the estate piece, I think on this third bullet here, Josh, and I'm sure you guys see this too, is if most of my net worth is in real estate and business, and somebody dies and I'm going to owe estate taxes, well, where's that liquidity coming from?
Yeah.
And that could be the fire sale, right? Where am I going to get the money to pay this? So that's where we have, that's where the planning really comes in, and that's where knowing what the business is worth is the starting point. but then you've got to put in the work to really protect the rest of the net worth and figure out where things are going to be coming around to you or to your heirs, or do we do a spousal lifetime access trust? Does that make sense? Do we think about gifting some to our kids? We've been in situations where owners have very, very profitable businesses, 18, $20 million these businesses are worth or more. And they're thinking, well, geez, I'm not gonna need all that money. Why don't I gift 5 or 10% of the business to my kids now, move some of that risk out of my estate, and then when I sell the business, they're going to be able to participate right now, as opposed to potentially having to wait until I die down the road to get some inheritance. So just having a conversation with the clients, right? And I think, Josh, the thing I'd be interesting to hear you guys weigh in on too is the idea of goals, right? If we don't know your goals, we're just kind of closing our eyes and throwing darts in the dark.
Well, and it's the same thing with equalizing businesses. I know there's some planners that are on today that it's one child is involved in the business, two or three are not at all. Do you hand the business off to one? How do you equalize inheritance for the others? Do you let all three of them be involved? Does that cause other issues? I mean,
Yeah,
when you have, do I own real estate with the business? Do I need to sell that separately from the business? Is it a separate transaction? Am I charitably inclined? All those types of things. And that's why I say, like, if someone comes to us 6 months before they want to sell, wow, yeah, like that's going to be a busy 6 months if it even possible.
yeah,
But I would tell you, and especially as you go through the tax structure, is I don't think people are prepared 90% of the time for the tax bill as if they don't plan at all.
yeah.
Whether it's asset sale or stock sale, I think the sticker shock of some of that tax bill is really hard for people to realize, much less that even when you're selling a business, unless it's again strategic buyer, things like that, you're not making more than you would have staying in the business. You're just making it up front.
Yeah.
Like again, if you're getting 7 times earnings, you're getting 7 of those years up front. Does that come with a bigger tax bill? And again, I mean, I was on a call this morning of using a strategy for the real estate, a strategy for the business, and a strategy for the personal wealth. All three were different, and none of them were set up basically 2 to 3 years before we needed to be. That
Hmm.
is a structure where even if it didn't feel like a fire sale, it felt like a fire sale from our side. So
Yeah. Yeah, it's a scramble. It's a
yeah,
scramble. And I think you're right. And I think to anybody who's thinking this through, you've got to have the conversations, because otherwise you can design scenarios until you're blue in the face, but they're not really hitting at what matters to those folks. And you're not, and the equalization one is really an important one, because that comes up a lot.
yep,
I've got 3, 4 kids, one or two of them are in the business. What do we do?
yeah,
And I think that becomes a really important conversation. In my opinion, the worst thing you can do is just give them all a piece of the business, because having people in the business that don't work in the business is always a recipe for fights down the line, where
yep,
we're dealing with a manufacturing client right now who, he runs the business, but two of his siblings are involved in the ownership of the business, but not in the business. But boy, do they like to cause trouble.
yeah.
Whenever there's an owner meeting, well, why are you doing this? What's going on here? And it's a very profitable business. It's, you really can't be happy with your $200,000 to $300,000 allocation every year of profit sharing. But anyways, it can get ugly. So just having those conversations, getting in front of it is huge.
When I think it stops the regret, because we've seen a lot of clients, especially the last 2 or 3 years, whether they didn't hit their earnout and or clawbacks or something like that, or they paid a bigger tax bill than they were expected. That regret creeps in, and Sam, I'll kind of commend you and Amanda for doing that. It's like you guys hit the personal side of that a lot more than a business owner expects, because again, it is part of their identity. One, but two, I don't think people realize that when you, again, if you're spending 25, 30% in taxes when you didn't need to, and it happens too quickly, and it's not the price you wanted, it's a recipe for regret. And most of the time in a family succession, it's a recipe for disaster.
Yeah. Yeah, exactly. Folks are unhappy with each other, and that never goes well, especially when it's your family, right? You do have to live with these people for the
Yeah,
most
yeah.
part. So
Thanksgiving, it's a lot more awkward when it's not what you need it to be. So
yeah. No, absolutely. That's an excellent point. Amanda, we'll turn it over to you. Do we have anything related to this topic? Oops, you're on mute.
Sure. One question we've gotten several of at this point is how should these professionals prepare their clients for what to expect during evaluation? Um, what does the evaluation process look like? What should they expect? And so just to help the professionals we're speaking to be able to educate their clients about what that might entail.
Yeah. Yeah, that's a great question, and I think that what the main thing that you need to prepare business owner clients for is that this is going to be more intense in certain ways than they thought because it's going to require pulling lots and lots of documents, right? It's not just, oh, let's see your P&L and we're gonna go and pull some multiple out and slap it on your EBITDA for the trailing 12 months. This is going to be 5 years of historical income statement balance sheet. We're going to want to see trailing 12 month if it's an intra fiscal year valuation date. We're going to look at receivables. We want to see insurance policies. We want to look at fixed assets if that's the type of business that you're in. And then we're going to ask lots and lots of questions, right? This is that piece about the pre-due diligence is part of doing evaluation from where Amanda and I sit is not just coming up with a number, but it's also being able to defend that number because when we do any valuation, but particularly one that's going to be subject to IRS scrutiny, gift tax, estate tax, even a sale price, right? Supporting a sale price. If a bank comes and says, "Boy, we'd really like to get a third party valuation because we want to know that our loan, there's something behind it, right? This company is worth something." This requires a level of detail and a level of digging that is very similar to what will happen in due diligence. Operational processes, organizational structure, who are your top clients? I think all of these things become really, really important. And so we can do typical evaluation can be 6 to 8 weeks, but it's going to require a little bit of a lift on the part of the owner. And I would say that to your point, Amanda, about what they can prepare folks for is if the CPA in particular can be involved, or if you have a good bookkeeper, either internal or external, this makes the process much easier because those folks are intimately involved and know how to pull various reports. They'll be able to answer a lot of the detailed questions that sometimes don't trickle up, especially in a good business, right? An owner of a 30, 40, $50 million business may not know exactly what's going on with payroll or how many travel expenses were personal versus business. So, so making sure that as advisors that we're trying to give that client help so that they're not just stuck there thinking, geez, how am I going to run this report or where is this information? That's usually where we end up stuck in this cycle of and Amanda usually takes the brunt of those questions of how do I do this or where's this information or what does this mean? Getting your CPA, getting a bookkeeper, or even an internal finance person involved can be a really good idea. Even if that person has to be covered by an NDA, it's still good to get them involved in that process.
and Sam, to your point out, like I know you know so much about the trades and you speak to all these associations. It's also, again, sometimes you don't want the owner to be involved in all of those little pieces. Sometimes that's a sign of actually good lack of owner dependency.
Yeah.
But two, it's much, and I've found, especially working with you and Amanda, is it's much more than the numbers. Client concentration, like again, slapping a number on EBITDA is great. That's good for a ballpark, but I don't think most clients and professionals realize how heavily involved the not the quantitative but the qualitative information is really important. Can you talk a little bit more about that type of stuff?
Yeah. Yeah, no, I think that's a really good point, and it really feeds into two places. Number one would be growth, right? If you have the right people in the right seats and they're not all 65 and going to leave within the next 3 years and haven't trained anybody, then we're looking at a business that's sustainable, and that's good for two things. Number one, it's typically a business that's going to grow well, and that could even just be top line growth, right? If we're doing better top line growth and maintaining our margins, that's going to dollar wise, we are now better at a operating net margin than we were even without changing our 12%
Anything. Right.
margin at all. Well, that business is going to be worth more, and it may even command a higher multiple, right? Because as the business gets bigger, less owner dependent, that's where we start seeing that five become a 5.5, right? And when you're talking about a business that's doing 4 or 5 million, let's say in EBITDA, that half a 0.5 in a multiple, that's real money.
Yeah.
Right? We're talking real money here, and so I think that's a big piece of it. The other piece that it comes into play is that discount rate, right? And the discount rate plays into both how future cash flow is discounted to the present value, but it also plays into the multiples that get paid. And the better you are qualitatively, right? Processes and procedures in place. We're not scrambling around to try to figure out, geez, Josh just had heart surgery. What the heck are we going to do? Who's signing payroll?
Signing checks. Right. Yeah.
Who's hiring and firing? Those are things that are critical, right? That continuity piece that reduces the risk. And the lower the risk of your future cash flow is, the higher the multiple is going to be, right? The more cash that's coming into my pocket as the owner, as opposed to who knows where, right? Pay an insurance claim or workers' comp or something like that. So these pieces are really critical and critical to get right. And that's why I think back to our discussion a little earlier about what can you do now to run your business as if it's for sale, focusing on those operational pieces, right? Processes, procedures, the technology, getting the right people, mentor programs. Those things will pay massive dividends, particularly if you're somebody that's 10, 15 years away potentially from an exit. That could make a huge difference in ROI.
Yeah. And Sam, I want to be mindful of time on some of the stuff. You want to hop to one, some of the transition options.
Yeah.
And then two, I just got a question. What size of businesses are sellable?
Yeah, that's a good one. So yeah, we can come back to this one if we want. This is fairly insurance legal documents. The one thing I will say here is critically important, and for most business owners, they've collected dust for the last decade at least. They Josh and Randy and Amanda and I are in a partnership. Well, we have a partnership agreement, but nobody's looked at it in 30 years. So who knows what it has to say. We also have life insurance on each other, but it's for $250,000. The business is now worth 20 million. Those policies aren't doing us a whole lot of good at this point. And so
Yeah.
this is something for folks on the call to encourage these reviews, biannual, I would say, or when a material event happens, to just have those business owners pull out these documents, review them. This is another thing that valuation can go into is, and we do it for a lot of clients where we'll do every 2 or 3 years, we'll revalue the business just so that they can stay on top of what insurance they need.
Yep.
So yeah, so let's talk a little bit here, and this is a big key. And one of the things that's happening in a lot of businesses right now is, or a lot of industries, interest rates are higher. There's not as much cash as there was, let's say, right in the middle of the pandemic going around, and there's more uncertainty. And so your buyers who 3-4 years ago maybe were willing to pay a premium just to take a good business off the market are being more selective. And so what that means is that there are a lot of businesses out there, and we can kind of answer that question too, Josh, about the saleable size business. There are a lot of businesses out there that might have been attractive targets that are now sort of stuck in limbo, right? Will the M&A market come back in your industry? It probably will, but when it will, or when your business will be something that's a hot commodity, that's harder to say. And so this is where I think understanding what else is out there is critical for any of this. And so again, this gets back to that goals discussion, right? If we don't know what your goals are, it's very hard to start. But looking beyond just well, I could sell to a strategic competitor, there are private equity backed roll-ups, and that could be that could be a very good option. But if your goal, let's say, is and talking to some of our clients, well, we're the last big independent business in the area, and we're proud of that, right? We're happy to be the one that can compete against a Home Depot or a Menards or one of these stores, big chain stores. Well, that might be a different goal, and that person may not be as motivated to sell to a larger company because they're proud, right? Their identity, their legacy in the community is that they're fiercely independent, let's just say. And so thinking through and one of the things that you can talk to clients about and have this discussion is I find oftentimes they skip right over this first bullet, sale to family or key employees, just because they assume that they don't want the business. That's a great chance to say, well, have you talked to them? Yeah, well, they're off doing their own thing. Okay, but have you had a conversation with them? Should we sit down and talk with them? Because we find, Amanda and I do a lot, that just broaching that subject all of a sudden makes them start thinking. And we've seen a number of instances where, yeah, maybe my son or daughter really would be interested in the business. Or after a couple of years, they go, yeah, I've been talking to my son, and he doesn't, he likes his job, but he'd be really interested in coming back and starting to work in the business. Great. Well, now we've opened up an option that we didn't think about. And so I think for all of us who are advising business owners, that's a really key question: is have you talked to either your family or these key people? Because chances are you might have an interested party. I mean, I know Amanda and I are working with a business right now where we went into it thinking we'd be an outside buyer, and then all of a sudden there were two internal folks who were interested in having a discussion about buying the business. And so don't discount folks inside the business, and that can be a really good transition for any number of reasons. And then kind of looking at some of these other, right? I mean, ESOPs, right? Employee stock ownership plans. We've heard of them. There aren't a ton of them, right? I'm sure a lot of people have heard of them, but I think there are 6,500 or so in the country. It's not for everybody, but if it works, and we do a lot of this feasibility study and thinking about how we can strategically do this can be really good, right? There's some huge tax advantages. I mean, if every business could start as a C corporation for at least 3 years, sell to an ESOP, defer capital gains taxes on the sale of the business, and then immediately upon sale convert to an S corporation and not pay any federal taxes going forward, everybody would do it, right? I mean, but they don't, so it's not for everybody. You've got to be a certain size, and you have to have certain types of goals. But these are things to think about, right? This idea of a worker-owned cooperative, this is coming up more now, right? And I think most people's idea of a co-op is the hippies that wear hemp and smoke weed and sell granola, right?
Yep.
But these are really good business. To think about Ace Hardware, right? That's a purchasing cooperative. They do billions of dollars of revenue a year. And so these can be good businesses. Again, selling to a worker cooperative, owners can defer capital gains taxes. Profit sharing that's paid out from a cooperative to the worker members doesn't get taxed at the federal level. So there are some big benefits to doing these. But again, it's what are your goals? What are you trying to do here? with the business. Where are you trying to get the money? How quickly are you trying to get the money? All of this plays into it. And I think this last one, this is a newer option that we're actually working on with one right now. But this idea of a perpetual purpose trust, right? This was the big Patagonia thing that I think a lot of folks know about. But it can work with smaller businesses, and there are good ways to gifting, right? If you know that your business is worth $30 million, but Josh and Randy tell you you're only going to need 20 million, well, maybe you make a gift of part of that business to this trust. And the cool thing about the trust is it's a trust. You can write into this trust things like, I do not want this business to be sold unless A, B, or C. I want this business to make charitable contributions every year to these causes that I care about. Right? I'm going to set up this board to oversee what's going on to make sure that my legacy is carried out. So all these things can be really cool. And what we're seeing too, guys, and something that goes back to your planning too, and one of the things we do structuring with a lot of these is think about a perpetual purpose trust going into it. Maybe the owner is running a business, they can open up a cash balance plan. Now,
Yep.
instead of getting paid with taxable money, we're sticking a lot of money into tax deferred, and that can change potentially the valuation of the company, but it can certainly help to shift some net worth away from the business. And so thinking through how these options work, how you can make them work for your goals. And I would say too that those first four, right? Sale of family key employees, ESOP, co-op, perpetual purpose trust, it's not an all or nothing. And that can be very attractive to folks. And so
Yep.
just keep that in the back of your mind that some people are happy. They want to sell 100% of the business. And if they can get out, and if the earn out and all that is not too bad, then maybe that's their best option. But some folks want a slower pace. They want to have control over that process. And so maybe they do 30%, and then a couple of years they do another 30%. And that can be really good. It can be good from a tax standpoint. It can be good from a mental health standpoint. It can be good from a company performance, right? Because now they're also participating potentially in the increase in value. So a lot of different ways to slice this, and why it's really important to start that conversation with your clients and to let them know that there are more options than they might originally have thought.
And we say the same thing on real estate. I mean, how many clients own their warehouse, own their office building, things like
100%.
that, and they don't want to sell it because of the capital gains, or they want to sell it all as one. I mean, the amount of Delaware statutory trust and 1031 exchanges we've done as a separate transaction from the business, for a lot of people, one, it's a great estate planning tool. You get the step up in cost basis, but two, and this is the most, it allows you to do things in multiple tranches. So
Yeah.
that way, if you want to sell the business or half the business or whatever it is, and then sell the real estate a year later, 2 years later, be able to kind of settle down and relax. The amount of clients that we've seen that won't sell a piece of real estate attached to a business because it's fully depreciated, now going into some, and again, they don't want to buy another piece of real estate.
Right.
They want to relax. They want to retire from being a landlord. Charitable remainder trust, donor advised funds, like the amount of things that go along with, okay, you pick this goal, you pick this strategy, what comes out of that? I think that's where that 3 to 5 years really comes into. Because unfortunately, and we've seen, I know you've seen this too, is they bring you a check, it's done. But hey,
Right.
we got a referral the other day, client sold business. Great. There's not much I can do now
Yeah.
that the wire has hit, and it's not a bad thing. Again, I'm glad you got the money, but the
Yeah.
amount of money you could have saved, the strategies that you could have used, those types of things. And again, I think just clients come to us, business owners come to all of us for advice. A lot of the advice is prior. That's as
Yeah.
simple as I can make it.
No, I think that's a great point, because all of this stuff sounds really good, but it only works if it's planned for and put into place.
Yeah.
Because
Seller
yeah,
financing.
again, and regret, right? It's
Yeah.
that regret thing. Yeah, well,
Yep.
geez, you could have saved 30% if you had done it this way. Well,
Yeah.
that stinks. That's a bad
Yeah.
conversation to have.
Yeah. We've got a small paint store, kind of a Benjamin Moore type paint store. She's a little too small to go into that big market, but seller financing to one of the key employees allowed her to sell the business, funds her for retirement, income for life, way more tax advantage. She thought she was going to be working there till she was 90.
Yep.
Those types of options to say, hey, have you looked at all your options, or do you even know what all your options are, is probably
No,
50% of the battle.
Exactly. No, I think you're right. And I guess just to get specifically back to the question about size, and I would say that think more about net cash flow than size. I mean, we've sold and worked with transitions with smaller CPA practices or dental firms that are around $1 million of revenue, right? So,
Yep.
we don't have to have, it doesn't have to be a huge business, but if you're doing 10 or $12 million of revenue, but you're barely scraping $50,000 on the bottom line, that's going to be very difficult to transition to anybody. And it's also not worth a whole heck of a lot. So think about net cash flow first, and then you can sort of back into what does it need to be top line wise. But if there's nothing going on the bottom line, there's really not a lot to sell anyways.
Yeah. Yeah. It's, again, I don't care what you make, I care what you keep.
Yeah.
Those are the types of conversations that are harder, but I think all of us need to make that transition too, as whether you're doing estate planning or tax advice or legal advice or anything of the sort, is when you're going through all these types of things, the value is dependent on the type of business. Again, $1 million, I know you and I have talked about this before, but a tech business that has 80-90% margins, they only need to do 2 or 3 million in revenue to have a great business. They don't need to do 30. They probably can't scale to do 30 at those kind of margins. So it all depends on the type of business, but thanks for answering that part of it. I know that was a question that came up a couple times.
Yeah, no, great question. But yeah, I would say, for everybody sitting here, start those conversations, right? Start those conversations, keep that 3 to 5 years in mind. And, just feel free to reach out to us, to Josh and Randy, and let's have a conversation, right? Because it does take a team of people. Nobody, myself, Amanda, Josh, Randy, nobody knows every single part of this to such detail. You need to bring in lawyers, you need to bring in accountants, insurance folks potentially. So start that conversation with your client, and then have that network of folks to reach out to, so that you can get the support you need to get your client what they need.
Yeah. And I would say, again, for everybody that joins, like, whether you're writing a tax plan for somebody, we're writing a financial plan, somebody else is doing an estate plan document, those types of things, legal plan, the succession plan, a written succession document, those types of things that you would work with Sam and Amanda and their team, that's one of those things that I don't see very often. Having a succession plan, if you have that, I mean, you're already 10 steps ahead of the ballgame between evaluation and a succession plan. Anybody who comes to us for those types of things, now I can say, okay, here's the strategies to minimize taxes, maximize your wealth, create generational wealth. If we're having to start at the succession plan of, do you know what to do? Do you know what you're worth? I mean, now it is 5 years when it could have been 2 or 3 with a good succession plan. So.
Absolutely. Well, thanks. I think it's the top of the hour. So this is great, guys. Thanks again to Josh and Randy and everybody who's here for having us. This is great.
Yeah, thank you so much, everyone. If you were late to join because of a issue related to your passcode, don't worry. We've recorded the entire meeting and we'll email it to everyone shortly after this.
Yeah, and I would say, Sam, Amanda, thanks for joining us. I mean, this was and kind of hosting this, Amanda. You carried a big part of this weight here, so I want to appreciate everything. But for everybody that joined too, again, I know you can see it on the screen. Sam has been a great resource for us and our clients. I know there's probably questions that we didn't even get to for, hey, how do I deal with this? How do I deal with this? These are types of people for, again, to help your business, but also to really just get some good objectivity. So Sam and Amanda, I couldn't appreciate you guys more.
Absolutely. Yeah. Same with you guys. Thanks so much
Same
for
to you guys.
Cool.
Thank you very much.
Thanks, everybody.
Okay. Bye, everyone.